if the market makers have a objective, right, to take market higher or lower, right, they will create an expansion move, right, like this, right, and this for you might look like expansion, right? This is expansion clearly, right? But it's actually manipulation. What is this doing? It's actually putting, rather it's accumulating. It's an accumulation. It's what it is people see this uptrend and they're going to be putting their stop losses below these obvious lows, right? Retail is not very smart. They just see obvious lows and they put their stop losses there. That they see this as a good level to put stop loss, right? Because maybe they draw a trend line like this, right? Oh, look, the market is trending up. Let me put my stop losses at these obvious levels that are totally safe. And then, but remember, smart money's objective is actually to take it lower. We don't know what their objective is, but we can maybe infer using smart money concepts. And this rally is too sus for us. It's too fishy, and we know what smart money is going to try to do. We target these levels, right? Where retail put their stops, we target these levels. So often what might happen is something like this, where we see fast delivery, and this is the actual expansion, right? This is only accumulation, even though it might look like expansion. This is the actual expansion. Expansion can be both ways. Expansion down or expansion up. Expansion simply refers to one-sided delivery, right? One-sided delivery. Going up, that's bullish expansion. Going down, that's bearish expansion. Yeah. So here is Asian range low. This is our classic consolidation version of expansion, or of accumulation and consolidation, right? Here is also, it is also accumulation, but it is in the form masked like an expansion. So we go lower, and we manipulate the London range low, and notice how we come down into the midnight opening price again. So the best buys will occur below the midnight opening price. The best sells will occur above the midnight opening price. So you can refer to the midnight open as a level to put a limit order. Asian range low can be your stop, and then London range high can be your target level. So that could have been your trade. And notice the time it happens, okay? Notice the time. 9:30, exactly 9:30, creates the manipulation. We take out this low. We come into where? Midnight open. We go higher. What do we take out? London range high. And this is 187 points within 1, 2, 3, 4, 5, 6 minutes. Right? 6 minutes. Let's take a look. One contract. That's $350. With 10 contracts, that's $3,000. Here's another example of accumulation, consolidation, right? So we accumulate or consolidate in Asia, right? Consolidate in London. What happens at 9 or before 9:30? We go higher, okay? Right at 9:30, we manipulate up, and then the real move is this. This is the real move. All of this was manipulation. Manipulate higher. Yes, you want to see 9:30 go higher, and then around 9:50 starts the real move down. Now I trade the 9:30 manipulation. So, but this particular day, expansion happened or manipulation happened before 9:30 open, right? See it at 7:40. 7:40 started the manipulation. So that tells me I'm wrong about my bullish bias and I need to reverse my idea. So at 9:30 I wait for it to go higher, then create this fair value gap, right? From here to there. And then when we close below that, I might have just entered right there, right? And gone for the London range low, the Asian range low, and that might have made my trade. By the way, when we have this kind of model where we consolidate, right, and then we start to do this, if we anticipate that smart money wants to take the price lower, this leg of expansion, which is actually the manipulation, will be pretty slow in its delivery relative to the actual distribution, which is the expansion, right? It'll look like this, very fast. It will not allow these orders to get out, right? It'll be much faster than this side of the curve. And this is called the market maker models, where we have a buy side curve, and then we have the sell side of the curve, which is much more aggressive. But we'll get into that. That's kind of more advanced. Right, you can keep going through these days and keep finding this same pattern. So we have accumulation in London, manipulate lower, expand higher. When? 9:30. 9:30 exactly. We take out this low. Okay, you could have entered there, somewhere here. Targeted London range high, and then that's 121 points. Same shit happens every day. What's up? You had a question? This day? Yeah. Right here? Mm-hmm. Yep. What about it? Well, again, you could have just entered at midnight open, put your stop below the Asian range low, right? So you could have entered at midnight open right there, and your stop would be up below the Asian range low, and you would look to take your target there. I enter closer into the 9:30 candle. So this is the 5-minute chart. This is the 5-minute chart. I trade on the 1-minute chart, so I zoom in even closer. So I go like this, okay? How do I catch this move going up? The fair value gap, okay? When the bearish fair value gap fails, right? This is my signal to go in. Because the bearish fair value gap, what should happen? Price should go in, tap it, and go lower, right? But when a bearish fair value gap fails, that is indication of bullish order flow, right? So when I see this close above the bearish fair value gap, I enter upon that close, put my stop at the low, and then I target some of these equal highs. So you see these equal highs here, right? And then we have this high, right? These are levels I want to be taking my profits. And there it is, see? So the inversion fair value gap is one of my favorite PD arrays. And you don't know much about PD arrays yet, but you'll get into it, right? Just with time. Yep. Well, it's the price of midnight. So right here, exactly at 12 a.m., it's the first candle that prints. This is the opening price of this candle here. So that's the price that we're referring to, and we draw it out in time. We draw it out, and we use it as a reference point for price. Well, I told you it was because of the inversion fair value gap, right? This fair value gap here is a bearish fair value gap. When it gets inverted, I enter right there upon the close of that candle, and put my stop at the low. That's all I do. We can take a look at another example. So here, let's go to the 5-minute chart. So here, same thing happened, right? We have London range low, we manipulate below it, and then we have a 5 minutes inversion fair value gap here. From here to there, we inverse that fair value gap. So upon this 5-minute candle close right there, right, put your stop at the low, target the London range high, and that's your trade. Take a look. Yep. Yes, I want to see a failure of a bearish fair value gap. Failure of bearish fair value gap means bullish order flow. Okay, so a fair value gap looks like this. Yep. Okay, so I explained that, right? So what a fair value gap should do is, in normal conditions, a fair value gap should respect price, right? So what does it mean? It should come in lower, so it should tap into it like this case here, right? Here we have a fair value gap. Okay, it should tap into it and continue its trend, right, that it started. So a buy off a fair value gap might look something like this. You enter on the fair value gap, you target the opposing range. Okay, so a fair value gap, right, like that looks like this, right? This is a bullish fair value gap. Price should come into it, right, tap into it, and continue the trend that was started here, right? Like for example, here again, we have a fair value gap, it taps into it, and then we keep going higher, right? Now this is called respecting the bullish fair value gap. When we do come into it and we keep going higher, this is respecting the bullish fair value gap, right? But here we have a fair value gap, right? This candle here and there, oops, right? And then we disrespect it. We come into it, but then we close below it, right? We don't just tap in and keep going higher. We close below it, we disrespect it. So that could be your signal to go short upon the close, stop at the high, and target something here. That could have been your short. So fair value gaps are powerful, but inversion fair value gaps are even more powerful. So here is a another case of a fair value gap working like it should. It went lower. Yes, it's respecting it and keeps going higher. But this is a bearish fair value gap. See, bearish fair value gap, right there, it gets disrespected. Bearish fair value gap disrespected. Order flow switches from bearish to bullish, and then you could have targeted maybe this high, maybe some of these highs. You can keep going through price and finding these cases. Here we have a bullish fair value gap. Right, it should respect it, but it fails, right there it fails. So because it failed, now price will accelerate down. Here we have another bullish fair value gap. Initially here, it was respected. It went higher into this level here, but then it got disrespected here. So you could have entered there and then targeted this low, targeted London range low or something like that, and that could have been your short. And here we have an example of a fair value gap being respected. It's coming into it, it's a bearish fair value gap, it's respecting it, and it's going lower. Okay, it's respecting it because it's not closing over on top of it, right? It's touching it and keeps going lower. It's respecting it. There's no bodies that close over it, right? Here we have another bearish fair value gap. We tap into it and we keep going lower. This is respecting the bearish fair value gap. Yes, if it is a bullish fair value gap. If the body of the fair value gap is green, like this one, if it's green like this, it's bullish fair value gap. If it fails, that's a sign that it's no longer bullish. We're switching the trend and we're going down. We're starting a reversal. So inversion fair value gaps are good at predicting reversals. Mm-hmm. Mm-hmm. Yes. Yes, correct. Yes. Yes, you got it. So if a bullish fair value gap gets disrespected, meaning that there is a body that closes over it and disrespects it, right? Closes over it like this. This body closes down and closes below it, which shouldn't happen if it gets respected. So this is a sign of disrespecting the bullish fair value gap, so we should go lower. Right, and you can look at fair value gaps. They constantly form everywhere. So there's a fair value gap here. It comes down. Look at the sensitivity around the center point of this fair value gap, and keeps going higher. So this is a respecting the fair value gap. But then there's this large fair value gap here, and this fair value gap gets disrespected. Right? When we did. So this candle here, actually, or this candle right here, is the disrespect. Because this is the first time, this black candle here is the first time there has been a body, look at the bodies, close below it, right? So if you're watching this in real time, so here we're still respecting it, right? There's no body that closed below it. As soon as this happened, that's your trigger. That's your trigger to go shorts. So this turns into inversion. You could enter there short, and you can target the limit range low and see how that plays out. Alright, so you can take a partial somewhere there. It doesn't have to hit your final target. You'll be taking partials along these lows and trailing your stop loss. Yep. Mm-hmm. Mm-hmm. So this is where time comes into play. Okay, so I trade in certain blocks of time. I don't just trade any random fair value gap that I see, right? I trade the highest probability time conditions. So I'm not trading any of this, right? I'm not trading any of this. I wait for 9:30 open, right? And if there is a fair value gap, so this is a news. This is CPI candle. So let me wait for the 9:30 open. Okay, so it did happen here, right? So I see a bearish fair value gap here. I'm waiting for that. Does it get disrespected or does it stay respected? Okay, it doesn't come into it even. I'm still waiting for it. Bang, it gets disrespected there, right? We get a body close over it. That could be my entry signal. I enter there. It is over, yeah. See, it closes over it. Yeah, we close over it. I mean, how far do you want me to zoom in? Like it closed over it, right? And then there we go. We can enter there. Put the stop below the low. Then we could target maybe this high or whatever extra highs. I think we're at all-time high at this point, so there is no other highs we can target. Unless we go to like the weekly chart and look for some sort of high there. So this could be the trade. Right. In this case, you would have maybe taken a partial and got stopped out there on break even. So not a lot of your trade ideas will work. Just because you see a bearish fair value gap get inverted doesn't mean it has to work. If smart money doesn't want to go up there, it won't go up there. So that's why there's always probabilities and everything. So this was just horrible price action. Here we have a bit fair value gap, gets inverted there, goes lower, and then we have bearish fair value gap, gets inverted there, but after it gets inverted, it takes out this high and then goes lower. So after you learn all these concepts by watching ICT's videos, you have to make your own model. Nobody trades like anybody else. Everybody has their own model according to their personality. So mine is the inversion fair value gap, right? That's my favorite model. Yours can be the OTE, right? That's one of my favorite as well. I love OTE. Whatever your eyes see better. Okay, any more questions? Yeah, I just went over the first episode, so you're still gonna have to watch all the other episodes. Oops, that's 2022. Oh, the thumbnail is wrong. It says 2022, but it's actually the 2016 mentorship. Okay, I'm gonna link you this playlist. There you go. Yep. That's good. I'm glad you enjoyed it. That's good. All right, I'll see you tomorrow. Bye bye.